Good afternoon. I'm Alex from Xavier Financial Mortgage, and today we have Ian Osterland with us from Acra Lending. Today we'd like to discuss debt service coverage ratios, commonly known as DSCR loans. Ian, thanks for coming in.
Absolutely, it's my pleasure.
So today, let's start off with basics. Well, what is a DSCR loan?
Yeah, so like you had mentioned, DSCR stands for debt service coverage ratio, and that can sound like a lot of intimidating words, but basically it is an investment loan that qualifies based on the property's ability to pay for itself. And what I mean by that is these are loans that do not require any sort of income to, figure out whether or not you can afford it. It comes down to, does the rental income that the property generates cover your monthly mortgage payment? And if the answer is yes, we have a loan.
So how do you actually consider the rental payment?
Pretty much any loan you're going to run into, with very few exception, one of the key pieces of that is going to be an appraisal, right? That's where a licensed professional will come out to your property that you're interested in. They'll review the property and they'll give an estimation of value. Well, one of the additional things that they can offer is they can do what's called a market rent survey. And they will then, in addition to looking at the area and establishing a baseline for the value of the property, they will also look at the area and establish a baseline of what are other rentals in the area going for. Mm-hmm. They'll then take into consideration, any square footage differences, rooms, things like that that might be different for those rentals versus the one you're interested in. Mm-hmm. And they will then establish a number. This is what the market rent for your area should be. As a lender, then we look at that number, compare that to then the monthly mortgage payment that you have, and that's where we establish, is that rental income going to cover your payment?
Would a VRBO or Airbnb work, or is it only leases?
Yeah, sure. No, absolutely. So short-term is absolutely on the table for many places for a DSCR loan, in the same way that appraiser would look at other longer-term rents in the area. If you had an interest in doing an Airbnb, or even in the event of a condotel, which is basically just a short-term condo, very typical for high-rises, they would look at comparable properties in that regard as well. So they would look at the Airbnb down the road instead of the long-term lease, or they would look at other short-term condo rentals in the same building, in the adjacent building, or what have you, and establish that income number from those properties.
Are there any exceptions? Are there any types of property that would not be able to be covered over, under DSCR?
Yeah, so that's a good question. So most property types are fine. Every lender is going to be a little bit different, but single families are obviously totally fine. Condos are totally fine, as case in point with the condotels being a property type of its own. But a lot of places will get really creative. Manufactured homes are available with many lenders for DSCR. Even things, I don't know if you've ever heard of a barn dominium, but it's basically a converted barn into a condo. Financing on those, it's a lot harder to find people that will do it, but they exist. So, anywhere from the more cookie cutter, the single families, the duplexes, great. You might even find the more outlandish, like the barn dominium or a manufactured home or things like that. So there's not really, it's all somewhere out there.
So what are some typical down payment requirements?
So whenever you're dealing with a loan product that's a little bit more outside of the box, you're usually going to require a little bit more skin in the game, if I will, or if you will, from the client. Right? It's a little bit riskier. You're not qualifying income like you would a conventional or an FHA or a typical loan. And so because there's a little bit more inherent risk without that backbone of documentation, usually there's wanting to be a little bit more down. So in most cases, you're looking close to probably about 20%. There are some you may be able to find in certain situations as little as 15. You will probably find that the ratio where your rates start to get pretty aggressive is in that 75% LTV or 25% down range. Because that 20% down is usually the benchmark for most places, rates aren't bad, But when you drop down to that extra 5% down, they usually start to get much better, much faster.
Credit score, I want to talk about a little bit. How does that factor in? Does that factor in heavily into the down payment requirements? And what else does it factor into?
Yeah, so that's a great question too. So credit score, pretty much with any financing you're looking for, is going to carry weight. With DSCR specifically, again, it can, depending on where you're finding financing, it can be in the 700s and you're getting a great rate. Some places even allow you to go down to the 600 range, and very few, maybe more of a kind of a hard money, which is a little bit of a different product. They may even go below that 600, but it does bear pretty significant weight. When you're talking good credit, so think like 680, 700 and above, your rates are going to be pretty aggressive. When you're below that, they do start to ramp up a little bit, again, inherent of a little bit of a riskier loan. Rates typically on loans like this too, they're usually only about a point, maybe a point and a half higher than what you're seeing on the conventional or the FHA or any of those government-backed loans. But obviously, one of the key features that may increase that rate is if we're dealing with a lower credit score. So credit events or missed payments or things like that, that will start to jump that rate up. Yeah.
Quite heavily?
Yeah, they can.
Yeah. What? Let's talk about terms a little bit. Is there what type of options do my borrowers have for credit terms? So length of time, can it be an adjustable rate, or is it only fixed? Well, what type of options do they have on the table?
Yeah. So most of the standard options would be available. They do exist.
30-year, 40-year?
Correct. So most places you'll probably start with a 30, and that can be fixed or that can be an ARM. 40-year is absolutely, though, on the table for DSCR as well. There are even maybe options out there for a 15-year, depending on where you might look. So pretty much any of those term options that you would be used to, or that anybody might find just going with a more standard loan product, those are also available on these.
So what about refinancing? Can we do a cash out with a DSCR loan? Can we do rate and term? What options do we have there?
Yeah, so absolutely that we can. So even kind of alluding back to what we had talked about, where we're figuring out how that cash flow ratio even works, looking at the appraisal to get that little bit of extra information on the market rents. One of the things with a refi is that we can look at the actual in-place lease that you have, or in the event of a short term, we had talked about Airbnbs, maybe a 12-month ledger, or a look back at those short-term rents. You can do a refi using those numbers or the ones from the appraisal as your benchmark for, is this property cash flowing? So, is this lease agreement that I have in place paying for my mortgage, this new mortgage that I'm getting on this cash out? Absolutely fine. Yeah, no worries there whatsoever.
In your honest opinion, what would you say is the biggest downfalls or pitfalls that investors make when they're applying for a DSCR loan?
So I would say probably one of the first things is you have to start somewhere. And so when people are starting to accumulate investment properties, sometimes the responsibilities that can come with that can become a little much if you're not used to owning multiple properties. Obviously, the more you do it, the more seasoned you become, you kind of get into a routine. So that would be one thing, is really try to maybe do some research up front before you go under contract on, hey, do I need a property management company to help me? Am I going to be able to respond to needs at this house in the same way that I can my primary? Do I have contacts for contractors that when that tenant calls me, hey, my sink is broken, that I have a speed dial on somebody that I can just call up? One of the nice things too with where we are currently, and this is just kind of a universal idea, is as rates are coming down, these properties tend to cash flow a little bit better. And so one of the things that you just want to be mindful of is the market, and that how that relates to what you are charging for your rent and what's on your lease versus what you're going to be paying. With some of the fluctuations that we've seen with rate, it can be difficult sometimes to maintain that balance to where you continue to stay in the green. Obviously, you want to take care of your tenants and you don't want to overcharge, but at the same time, you have to be aware that higher rates mean higher payments, and so rents need to be higher. And so it's just all of those things just to kind of think about that I would say is more prevalent when it's your first investment, but they are things just to consider.
Well, Ian, thanks for coming by, and fantastic information and great advice. We really appreciate your time.
Yeah, absolutely.
Thank you very much.
My pleasure.